A bank just denied a mortgage on a $1.2 million home in California. The buyer had perfect credit. The property had no liens. The neighborhood was pristine. But the bank said no. And their reason? Climate risk. This isn't a fringe case. It's the beginning of a silent crisis that's about to hollow out the real estate market. And most homeowners have no idea it's coming. Within the next decade, entire neighborhoods, some worth billions, could become unmortgageable. Not worthless, unmortgageable. And if you can't get a mortgage, you can't sell. And if you can't sell, you're trapped. For decades, real estate was the safest investment an American could make. You bought a house, its value climbed, and you could always sell it. The market was built on one fundamental assumption: property values go up. But that assumption is now breaking. Banks have begun pricing in something new: climate risk. And they're not waiting for the crisis. They're already denying mortgages to homes that exist today in places that seem safe because of what those places will look like in 20 years. In 2024, mortgage denials in coastal zones increased 31% due to climate risk factors. By 2026, major lenders are expected to implement even stricter climate-based pricing. This is what a market repricing looks like: not dramatic, invisible, until it isn't. Here's how the machine works. Banks use algorithms that analyze climate data, flood risk, wildfire exposure, heat stress, water scarcity, insurance availability. They're not guessing. They're analyzing 50 years of climate data against property damage claims. A property on the Pacific Coast? Flood risk extreme. Coastal home in Florida? Flood insurance unavailable in some areas already. Interior home in Arizona? Water scarcity risk high. Wildfire zone in California? Insurance costs tripling. And here's the trap. If the bank won't finance the home, you can't sell it at market price. Not because it's damaged, but because the buyer can't get financing either. The price collapses. Your equity evaporates. Banks aren't denying mortgages because homes will flood tomorrow. They're denying them because insurance won't be available or affordable in 10 years, which means the home becomes unmortgageable, which means it becomes unsellable. Let's look at specific places where this is happening right now. Florida has 2.9 million homeowners living in flood risk zones. Insurance companies have already begun exiting the state. Private insurers can't afford the claims. The state's insurer of last resort, which is taxpayer-backed, is running out of money. 14 major insurers exited Florida in 2024. Homeowner insurance premiums up 40 to 60% in coastal counties. In some areas, flood insurance exceeds the annual mortgage payment. California's wildfire exposure is reshaping the real estate map. Last year, 8 million acres burned. Insurers are raising rates 100 to 300% in high-risk zones. Some companies simply won't insure homes within 5 miles of prior fire damage. Over 1 million homes are now uninsurable or facing rates above $5,000 a year. Lenders refuse to finance uninsured properties. Property values in fire-adjacent zones fell 12 to 25% in 2024. Arizona, Nevada, and Southern California are facing a different existential threat: water. The Colorado River is in crisis. Lake Mead is below 30% capacity. Water allocation cuts are coming. Mandatory water cuts in Arizona and Nevada effective 2026. Some communities already on Stage 4 restrictions. Property values in low water security zones declining 8 to 15% per year. Here's what happens next, and it compounds. Step 1. Insurance becomes unavailable or unaffordable. Step 2. Banks won't finance. Step 3. Sellers are forced to slash prices. Step 4. Not everyone sells. Some are trapped. Their equity vanishes. Step 5. Property tax revenue in the neighborhood falls. The city cuts services. Schools decline. Crime rises. more people flee, more homes become undesirable, prices fall further. This isn't a slow decline, it's a cascade. Once insurance exits and mortgages are denied, the neighborhood can collapse in 5 to 8 years, not 30. And here's the cruel part. The people hit hardest are the ones who bought a decade ago, paid off 30% of their mortgage, and can't sell because no buyer can get financing. Here's what the next decade looks like if current trends accelerate, and they will. 2026, water rationing begins in the Southwest. First mandatory cuts hit Arizona and Nevada. Insurance companies implement nationwide climate risk pricing. Mortgage rates for high-risk properties increase 1 to 2%. In 2028 to 2030, insurance availability crisis peaks. 15 to 20% of American homes in high-risk zones become uninsurable or unaffordable. Mortgage denials climb to 40% plus in coastal and fire zones. First wave of forced sales. In 2032 to 2035, market restructuring is complete. High-risk zones are repriced 30 to 60% lower. Entire neighborhoods in Florida, California, and Southwest suffer cascading decline. Real estate market bifurcates. Insurable homes hold value. At-risk homes become speculative or unmortgageable. The mortgage market didn't collapse in 2008 overnight. It took years of warning signs that most people ignored. This is what the warning looks like now. Banks are already repricing climate risk. Insurance companies are already exiting. The question isn't if the market will adjust, it's how many people will be caught holding devalued assets when it does. Your home might seem fine today, but the data that banks are looking at says something different, and the market moves on data, not sentiment. Subscribe for more investigations into the economic forces reshaping America.